Roy Barron, there's a lot of deals happening in the market right now. But before we talk about a specific deal, tell me how you manage the merger fund.
The merger fund is a specialized vehicle that uses a strategy called merger arbitrage. Merger arbitrage entails investing in the companies that are involved in mergers and acquisitions and other types of significant corporate reorganizations with the goal of profiting from the successful completion of those transactions. For that reason, the success or failure of the investments is dependent upon the transactions themselves, and the strategy itself provides a market-neutral profile.
Well, one deal which failed recently was one between Comcast and Time Warner Cable. Were you involved in that deal, and what do you think is going to happen next?
We were involved in that deal. It was a very high-profile deal. The parties employed armies of lobbyists, armies of lawyers, armies of accountants. There was a very good strategic fit between the two companies, so the deal made a lot of sense. Unfortunately, the market share of the combined company, both in cable viewers as well as internet access, was extremely high. Comcast tried to address that by divesting itself of millions of subscribers, which appeared to be an adequate solution to the problem. But what was not addressed was the high market share in what people call broadband access, which I think the FCC has defined recently as 25 megabits or faster. And that ultimately proved to be the sticking point. That was a hurdle beyond which Comcast could not get. The FCC needed to approve it based on the fact that the merger was in the public interest. So although they were able to address the cable subscriber issue, they were unable to get beyond the broadband access issue. And the FCC then decided that they were going to refer the matter to an administrative judge for review, which effectively was a death sentence for the deal. It would have delayed it for over a year.
And what do you think is going to happen next?
Well, Charter Communications, which is controlled by John Malone, had made a bid for Time Warner prior to the agreement with Comcast. At several conferences during the pendency of the Comcast deal, Malone was asked if he was still interested, and he said yes. I think the phrase he used was hell yes. Now that the merger has been terminated, there have been various press reports that Charter was still interested in bidding for Time Warner. Time Warner apparently, according to other press reports, has been shopping itself, supposedly to Cox Communications. The outcome of that is unknown, but it appears pretty clear that Charter remains an interested party. Their stock, their prior bid was worth a lot less than the existing Comcast bid, so they'd have to increase that bid. The talk around the street right now is that any bid would need to be in excess of $160, perhaps as much as $170 per share in order for Time Warner to entertain it, but that's just speculation.
How will rising rates affect a fund like yours? A lot of people get into merger funds or arbitrage funds because they don't want to be correlated to the market. But what happens with rates rising? How does interest rate risk affect you?
It actually is a plus in a rising interest rate environment. Our strategy falls within the category of investments called absolute return investing. And absolute return investing provides returns that are not just uncorrelated with the market, but stable and typically have a very low level of volatility. So for that reason, those types of returns are compared more often to almost like fixed income investments. And so the return available from a merger arbitrage investment typically is composed of what you could get in a risk-free investment like a treasury bond or treasury bill or government obligation, plus some other form of compensation for taking the risk that a deal may or may not be successfully completed. And so if you accept that thesis, which is actually a fact, that you're getting compensated in excess of your cost of capital for investing in a particular merger, then if the risk-free rate goes up, for example, if T-bills or T-bonds go up to 5%, then nobody would invest in a merger transaction that offered you only a rate of return of 4%. So market forces would drive that return higher or the arbitrage spread wider. So in an environment, let's suppose, for example, that government obligations are offering 7% or 8%, then in order for people to want to make an investment in a merger deal, that merger investment would have to offer a higher rate of return. And typically the range historically has been 250 to 350 basis points above the risk-free rate. So that's why in a rising interest rate environment, merger arbitrage would be an attractive strategy to consider, because if you own bonds in a rising interest rate environment, the value of your bonds will clearly go down. But if you own a alternative investments, such as an absolute return fund or a liquid alternative, which we manage, in addition to a fund called the event-driven fund, then those returns would be expected to increase, diversifying or somewhat hedging the portfolio of fixed income investments that you may have.
All right, thanks a lot, Roy.
My pleasure. Thank you. Thanks for having me, Greg.
Thank you for watching The Street.